Welcome to Proven and Probable. I'm your host, Maurice Jackson, and joining us for a conversation is Chris Temple, the editor and publisher for the National Investor. Mr. Temple, welcome to the show.
Hey, Maurice. Good to be with you.
Well, we're honored to have you on the program as you have a well-established repute for your top-down analysis as you rarely look at a stock in a vacuum. Now, your investment thesis takes a holistic approach to investing, which allows you to identify value propositions that the market has not yet recognized. And so I wanted to begin with a macro view and ask you, should we be concerned or excited about the current state of the global economy?
Well, it depends on, for some people, especially here in the U.S., which form of TDS you have. If you have Trump derangement syndrome, you should be concerned. If you have Trump deification syndrome, you're excited because you think we're going to have the golden age and the greatest economy in the history of the solar system, et cetera. But I always like to look at things dispassionately as much as I can without either of those versions of TDS, Maurice. And to me, there's two major factors that concern me. Number one is we long since got away from having the traditional business cycle in the U.S. We have a credit cycle that started back in the 1980s. We have increasingly gaudy expansions of money and credit and speculation that give way from time to time to a bust. Then the Federal Reserve inflates it all again, and we rinse and repeat. We do this all the time. And so we're at a place right now, in my view, where the credit cycle, which was made even more crazy in the immediate aftermath of the COVID onset, when the Federal Reserve here in the U.S. printed something like 30% of the U.S. dollars ever in the existence of our country inside of less than 3 years. So that extended the credit cycle that started a little bit before that. And the question now is, what is it going to take before we have a blow off of that? Because there's all kinds of stresses, and not just in the U.S., but globally, in credit markets, the levels of debt and so forth. And exacerbating that, and in some ways I would have to say helping our cause, looking at it just from the U.S., in this, is this dynamic that all of a sudden everybody is talking about called the Don Roe Doctrine. You know, President Trump is part himself, part James Monroe, part Teddy Roosevelt, and part, regrettably, a neocon who you don't know what's going to come from him next. And he's a major catalyst that's really accelerating this whole realignment in the world. I mean, we had this relatively static environment after the end of World War II where the U.S. was king of the hill. Everything revolved one way or another around the U.S., the U.S. dollar, U.S. priorities in the world. And now that's started to change. And it wasn't just Trump that started that change, but he's accelerating it. And so what shoes we're going to see drop in the days ahead, where that's concerned, I don't know. But that has carries the risk of having a major upset in the global economy that would make these debt issues even more likely to have to be reckoned with right away.
Now, germane to your responses, here's the Federal Reserve. Are you expecting any surprises from the Fed this year, and how may that impact your investment thesis?
Well, you know, the Fed has burst into the news again recently with this investigation, such as it is, that the Justice Department announced against the Fed and specifically Chairman Powell. Before that, my attitude was that the Fed is not going to have much room to be as accommodative on interest rates this year as a lot of people think. It was a very grudging last rate cut that we got from them in December, as you may recall. And the problem is that we have seen resurrected in the recent past the beings called bond market vigilantes that were really prevalent back in the late 70s and early 80s. And this is the way the market's supposed to work, Maurice. If you're the market, if you're running a bond portfolio or any kind of investment portfolio for that matter, and you're looking at the risk and reward prospects of buying U.S. Treasury bonds, when President Trump wears on his sleeve that he wants a cheaper dollar over time and cheaper interest rates, that's going to make inflation not only remain sticky, but it's going to cause it to go back up. And if you're a bond investor, you're not going to settle for a piddling interest rate given that risk, you know, and no one is saying at all that the U.S. is going to, quote, default on its debt. But the way that governments have always defaulted somewhat in a soft way is by debauching the currency, by inflating the debt in such a way that it's relatively less bad when you look at it in the context of the overall economy. So I think the bond market vigilantes are going to keep pretty tight rein on the Fed, and the Fed is going to have to acknowledge this. And so I think that the surprise potentially that markets aren't expecting is that there may be 0 or 1 more rate cut from the Fed this year, possibly, and no one's got this on their bingo card. If all of a sudden inflation were to reaccelerate, or you got some crisis with the dollar or the bond market, a couple or 3 treasury auctions go bad, no one has on their bingo card the possibility the Fed would raise interest rates this year. But it's not impossible.
In terms of the Fed reducing the rate, what kind of basis points would you think, or are you looking at?
I think it's going to be relatively slight. There is a fiscal imperative that President Trump is concerned about, Treasury Secretary Bessent is concerned about, because of the $39 trillion, I'll round it off, we're going to be there imminently anyway, of acknowledged official U.S. government debt right now on the part of the U.S. Over $8 trillion of that has to be rolled over in 2026. And that's on top of $1.5 trillion to $2 trillion that is going to be new debt that needs to be financed. Now, Bessent has made clear that his strategy with the long end of the bond market not behaving because of those bond market vigilantes, you got to be nuts to loan your money to Uncle Sam for any length of time at 2 or 3%, even though that's what Trump and his team seem to want and think they deserve. So they're going to be all on the short end. I mean, the biggest payday borrower ever is going to be Uncle Sam in the days ahead. They're going to try and do everything on the short end of the yield curve, and that's why they're pushing so hard for the Fed to lower rates. But the problem is the more that the Fed lowers rates, the more it emboldens the bond market vigilantes and concerns everybody else to say, hey, they're not serious about reining in inflation. They're not serious about the value of the dollar. And so we want a higher interest rate on treasuries. Look at what's happened in the last 2 years. We've had 175 basis points total, top to bottom right now, or what the bottom is at the moment, of Fed rate cuts. What have long-term interest rates done? They haven't responded whatsoever. They've been volatile, but the level of long-term rates is about where it was, give or take, depending on what you're specifically looking at as far as maturity. It's about where it was before the Fed started cutting rates. So they've got to be really careful. This is why the government wants to lower rates. But if they do that, they're screwing the middle class, because mortgage rates and other borrowing costs will go higher, not lower, because those are tied to the longer end of the bond market. So they're in a pickle, and this is what happens when you're at the I variously call it the end game of the fractional reserve banking system, or the end of financial repression, as we've been also calling it recently. Look at Japan. What's going on in there?
Oh, yes.
Yields have really gone nuts, and the Bank of Japan now has had to start raising rates to keep a complete debacle from happening with their debt market and their currency. Don't think it can't happen here.
If the Fed is the problem, let's discuss what may be the solution. Now, you're a vocal advocate for a national infrastructure bank.
Right.
What is the NIB, and would the NIB be a central bank that would replace the Fed?
Well, first of all, I'll answer that last question first. No, the National Infrastructure Bank would be in character and by its charter similar to, for example, the Resolution Finance Corporation that was created during the Depression to enable financing of various public projects and things like that. More recently, and this is probably less of a good example, but for lack of a better one, you've had the government agencies that deal with mortgages. Fannie Mae, Freddie Mac are separate entities, and they don't necessarily directly with their activities impact the overall federal budget. So here's the dilemma. We have a $39 trillion national debt. Again, I'll round it off. We're adding $2 trillion of that a year, or to that per year, for as far ahead as you want to look, give or take, thanks to President Trump in last spring, his one big, beautiful baseball, hot dogs, apple pie, the flag, and MAGA bill, all that kind of thing, which did almost nothing to reduce the trajectory of government growth. We are still 1 year into Trump's presidency spending money federally at the rate of the Biden administration that was supposed to be an emergency spending level after COVID. So once you unleash all the spending in these government programs, history shows they don't get put back in the toothpaste tube. So given that situation, the many, many trillions of dollars that we actually need for the Main Street economy, for infrastructure, for mining, to create more processing and stuff like that, it just isn't there. I mean, one of the good things that President Trump has done is to give us the best policy tailwind of our lifetimes, where, the whole America First thing is concerned, to bring back mining and energy and stuff like that. But the amount of money that's been dedicated so far is a pimple on a flea compared to the enormous amounts of money. And again, we're in the many trillions of dollars. The National Infrastructure Bank, if you go to its website, nibcoalition.com, when you look just at infrastructure needs, and they follow the annual report card that there's a group of engineers and whatnot puts out every year. They grade the state of our nation's infrastructure, and it's not very encouraging. And they're talking trillions just to rebuild roads and bridges and schools and our power grid, things like that. Forget about the mining. Forget about all the new energy now that we need because of AI and data centers and all the rest of that. Oh, yeah. The money just isn't there. If you look at this from the federal government standpoint, and President Trump said as much early last year in one of his executive orders that saying we want to get critical minerals and mining and stuff back on its feet in this country. Well, great. Where's the money? It's not coming from the federal budget. It's starting to come from the private sector more so, but if all of a sudden we had another recession or a deflationary bust for a while again on Wall Street, you can kiss all of that goodbye. So what the National Infrastructure Bank does is it has a mechanism to take existing debt that's already been issued. The owners of that can loan it to the National Infrastructure Bank. The National Infrastructure Bank uses that as collateral for its own money creation, which is how banking works. And you can multiply it several times. And now you've got trillions of dollars, but completely off the books of the federal government to do it. Now, is that the perfect fix? No. The perfect fix, in my opinion, would be to abolish the Federal Reserve and its entire fractional reserve debt-based system and have a true national currency with whatever goes along with that is directly controlled by the people, not by these private banks. But we're not going to get to that anytime soon, regrettably. So the best stopgap to provide the economic growth that we need, in my view, is that National Infrastructure Bank.
Sir, if you're having a hard time breathing, that's because I am actually hugging you, squeezing you through the screen right now. I love that response. Get rid of the Fed. Absolutely. Well, yeah. All of the aforementioned actually seem to set the stage for those that are listening today and want to hear your insights. Let's switch gears and discuss physical precious metals. What are the precious metal prices telling the market, and what actions are you advocating for your clients?
Well, first off, I have said for my entire professional adult life that everybody, to the extent they're comfortable with and they think that they need based on their circumstances, where they live, how they live, and so forth, should have at least some what I call mad money on hand. In case you actually needed to use your physical gold and silver coins to barter with. If all of a sudden, and look, China's not going to invade the U.S., Russia's not going to invade the U.S., but you can have an attack on our infrastructure, and basically you go to your computer, you got nothing. You've got no bank account, you got no brokerage account, you've got no utilities, you got no gasoline, all right? And these things, we get trial runs for this all the time here in Florida when we have a hurricane or a tropical storm. We may not have power for several days. You got to exist. You got to feed yourself. You got to protect yourself. So physical precious metals have always been, I think, a good insurance policy. You should have that, like you should have a homeowner's policy or a auto policy and whatnot. The big moves that we have seen in the recent past, with gold and now silver screaming higher in the more recent past, for somewhat different reasons, I believe, than gold. But when you boil it down to both of them, Maurice, I think that this really underscores the fact that the big money, the central banks of the world, large institutional investors, high net worth family office people, and so forth, who have been driving this in various ways. This is what a lot of people start to refer to, and you probably have heard this yourself, as the debasement trade. Now, we haven't seen that kind of a trade in gold and silver, frankly, since the 1970s. when President Nixon took the U.S. off the gold standard, the dollar went careening downward in value. Inflation went up, interest rates went up in a couple or three different episodes before supposedly that was all abruptly ended by Paul Volcker in 1980-1981 time frame. He only shifted the inflation, which is a story for another day. But back then, the only debasement trade that people were looking at was in the U.S. In relative terms in those days, Germany, Japan, the other, major industrial nations, they were not blowing up their currencies yet. Okay. But in the years since then, now everybody is doing it. There's this tag team race to the bottom to see who can, inflate debt more, reduce their currencies more than the other countries. This race to the bottom with the declining valuation of these fiat currencies relative to the real economy and to real goods and services. So that's why after many years when central banks were selling gold once upon a time, they've been buying it hand over fist for a while now.
Yes.
The interesting thing to me, though, is that we still have not seen the retail crowd come in a big way as happened as recently as that big spurt in gold and silver between 2009 and 2011 for a spell. And the reason for that is that there's too many other things, at least up until now, that have been working for individual investors. Why are you going to wear a tinfoil hat and buy gold or silver when you can buy AI stocks or the Mag 7 or cryptos or whatever the case has been? But all of those are starting to crack, and we're going to see more of that.
Now, do you favor a particular metal and why?
I favor gold because notwithstanding silver's recent spike and my being bullish on both of them long term for alternating reasons, gold is still number one because it's the one that central banks are looking at as reserve currency. Central banks are not buying silver as reserve currency or not buying it as a strategic asset. More recently, they're buying it just like we had a spurt in uranium for a while. We had spurts in lithium and nickel because of shortages. And all of a sudden, the narrative in the market with silver is that, and you've known this for years, I've known this for years, and a lot of our listeners have, that there's just not the supply of silver if all of a sudden demand comes. It's like, the house is being called, saying, okay, pay up.
Yeah.
It ain't there, So there is that element. There's the industrial element, which honestly concerns me because I think if we did have a deflationary occurrence for a while again in the market, which again, we're overdue for, I would not want to have a heavy position in a lot of the other base metals, probably not in silver. I would be taking profits actually in that area. But long term, after we have, if things play out as I think, after we have the markets blow off, which in a rush to liquidity, everything goes down. It's been hot recently, but they don't all stay down. And I think metals would lead the rebound afterward, just like, frankly, they did in 2008. I mean, gold dropped by 35% in weeks.
Yes, I recall.
Yet by the end of 2008, it was the first thing rallying, and it took the stock market a few years to get a meaningful rally underway.
Now, given that gold and silver currently are experiencing all-time highs, for someone that does not own precious metals, are they too late to the party?
I don't think they're too late necessarily. Again, I think near term, a lot of the easy money in this move has been made. But let me qualify that a couple of different ways. First of all, I think at any point, especially if you don't already have physical metals, which, as I said, would be good to have on hand as mad money to barter with if you needed it. Dollar cost average. Figure out how much of a budget you want to spend. Buy some now, buy some in a month, buy some 2 or 3 months from now. You'll get an average price. 5 or 10 years from now, $90 silver is going to look cheap. Right now, you look at it and say, damn, I wish I'd have bought more at 20 or 40 or 50. Because near term, I think that, we could get a correction again, which we started to get for a while until the President Trump's latest antics over the Fed. The thing that's nice right now is to understand that for a lot of really good exploration stocks, the ETFs that focus on gold and silver equities, they've done very well. They had a lot of catching up to do. They lagged the initial gold move for a long time. Finally, in 2025, started catching up, along with a lot of the good and better known gold and silver equities. But a lot of really good exploration juniors are still sitting out there having moved relatively little, some of them not at all. And there's good stories. And what always happens when you have moves like this, Maurice, that start to broaden and then eventually, as they will, become a mania for investors, like the AI stocks have been and others have had their turn in that. That's when the good exploration story and even the not so good exploration stories start to catch on. People buy everything. So you got a great and glorious opportunity now when more and more investors have started to wake up from their slumber. Okay, I've seen all these stories about gold and silver hitting all-time highs, and gee, I might have missed a boat on XYZ company, but look at ABC company over here. They got a pretty good story, it seems, and they didn't really move yet. Maybe I should buy that. So that's what people should be doing right now, whatever you think the near-term moves of gold and silver are going to be.
Well, you referenced a lot there. So in terms of buying precious metals, if I may put a plug in for myself, we are licensed to buy and sell physical precious metals through Miles Franklin Precious Metals. I would be honored to earn your business. You can call or text me directly at 855-505-1900. That's again, call or text me directly at 855-505-1900. Now, you referenced metals and also, again, resource stocks. We see the metals performing well, but many mining equities are still lagging behind their historical multiples. When does the great rotation in the miners actually begin?
I think, Maurice, it begins in earnest when investors, and I alluded to this a few minutes ago in one of my other answers, investors need to have other doors closed to them. And I want to go back again because this is a great example to the period in the immediate aftermath of the great financial crisis in 2008. Everything was broken. You know, the economy was toast. The real estate market had imploded, all of these different things that we remember from back during that time. And the Fed, to try and right everything, started to lower interest rates to nothing. The world was introduced to this newfangled quantitative easing, where the Fed becomes a buyer of last resort and buys all of these government bonds at zero interest to keep interest rates low. But interest rates weren't the problem back then. The problem was that everybody had borrowed too much. They'd been too speculative, and it didn't matter what the Fed did. The economy was going to have to, suffer through digestion and regurgitation and whatnot that it did suffer through back then before things could get any traction again, even with the Fed lowering rates. So what happened was, with the Fed taking interest rates down, printing all this money through quantitative easing, stock market wasn't responding. It was still too broken. Ditto for real estate. So by process of elimination, people looked at this and said, hey, maybe those guys with the tinfoil hats that said we're going to have hyperinflation are right. Because here the Fed's going nuts, printing all this money to try and help things out, but it's not helping my stock portfolio. It's not helping my real estate valuation yet. I mean, they did rebound later. And that's why people in much greater numbers among generalists and other retail investors went back into the precious metal stocks. And that was really the point, as you remember, I know, when they all had their greatest run. It all peaked in 2011. Oh, yeah. And it's only recently, after all these years, that mining stocks, and I'm speaking, of course, in general terms, have gotten back to where they were way back in 2011. But it took the gold price 3 or 4 times higher to do that. Now, I'm expecting the same pattern again. Inevitably, these bubbles on Wall Street are unsustainable as I see them. We're going to have to deal with the grim reality of inflation and interest rates staying high, if not going higher than they are right now. That's going to take the bloom off the rose, and God knows what other shoes are going to drop that finally would wake people up to the fact that even as we sit here now, 2/3 of the American population is living week to week or month to month. This wonderful economy that we're told about, these great goosed GDP numbers, impact 1/4 to 1/3 maybe, when you get right down to it, of the American people. And they're going to start more and more to feel that everything is overextended, everything is stretched. And again, when you understand how credit cycles work these days, we are way past the living on borrowed time phase. And so we got to be concerned about that. And when that happens, whatever is going on in the markets, we all know the playbook because we've seen it. The Fed will trot out QE in a bigger way again. They already did a little bit last month, but they'll trot out QE in a bigger way. They'll add another zero. But especially if it's a big bust or a big economic shock we're in store for, it's not going to help. And so we'll have the same situation we did before, where all of this added monetary easing by the Fed isn't going to help the economy right away. It's not going to help resurrect stuff that was ridiculously overpriced and now has to come back to earth. So again, I think like 2009, 10, 11, that time frame, investors will have little choice but to take those mining stocks a lot more seriously. So the big move for the mining stocks, in my view, is still to come.
Oh, these are great insights. Can you take us behind the scenes and please share with us how you've been able to have a successful pedigree of 46 years of selecting winners in a tough market?
Well, no one's right all the time, but I think that if I have to point to one thing, and I've got a couple video tutorials I'm finishing up that are going to be out imminently that I'd love for people to see. I had an epiphany in the beginning of my career, literally out of high school. I got licensed to be in a retail financial planning business and sells insurance and mutual funds and stocks and things like that. And it was at that very pivotal time that I referred to earlier where Paul Volcker had taken a range at the Fed. He changed things from having this runaway inflation and crashing dollar. He jacked interest rates way up, flipped a lot of things on their head, and that caused a lot of epical changes in our economy. And it really motivated me to understand this. And so for years, my signature essay has actually been called Understanding the Game. And I tell people, this is not rocket science. This is simple math. You know, no one is taught these things in school or when you get a banking license or a stockbroker's license or anything. But if you watch this tutorial of mine after an hour, give or take, you'll understand more about how the system works than your average banker and stockbroker does. And you look at this and say, wow, I didn't know it was this simple. But again, it's simple math, and it's allowed me to understand the markets, I think, better than most people. And, you know, sometimes you make a mistake, but in the big picture and the big swings of the markets, I nail pretty much every one of them. And it's not rocket science. I don't have a Ouija board or a crystal ball or, you know, bat entrails that I use to come up with a formula. I use math and common sense. And so it's really understanding the game, understanding the nature of the Fed. What is fractional reserve banking? How do these dollars we all obsess over? What are they and how do they come into business to begin with? Because most people don't get that.
Let's discuss the value gap. Now, you're known for identifying value and opportunity. What are the three most important red flags you look for when vetting a junior resource company?
Well, I think, and I'll look at it more in a sense of maybe a positive way to look at it. And I want to make sure that because I got a couple of things I wanted to refer to here. You know, and I'm going to stick, and we'll stick with the context of resource companies, although these same principles, I think, apply to pretty much any kind of company you're looking at. Number one, bet on the jockey. You know, it was about 2 summers ago, that we celebrated the 50th anniversary of Secretariat's Triple Crown win, which was one of the greatest sports stories of my lifetime. The horse was phenomenal, but he also had a great jockey, and maybe another jockey would not have allowed that horse to achieve what he did. But in horse racing, people that bet on horse racing, they look at the jockey. When you're looking at a company, look at the jockey or jockeys that are involved. Are they talented? Have they had experience? Have they had winners before themselves, before taking the helm of the company that you're looking at? What are their bona fides? You know, you also want to look at, and this kind of goes with number one. Number two, can they raise money? And one of the things during this long, you know, kind of dry spell that we had, especially in the junior resource stocks from 2011, the peak back then, until fairly recently, it was hard to come up with money, even if you had a good project. But I can tell you this, Maurice, that in the last year or two, projects that deserve money are getting it. You got people lined up. So that's a little bit easier to flesh that kind of litmus test out, because if you're looking at a junior stock and you're looking at their marketing or, you know, listening to their CEO or whatever, and they're telling you, oh boy, it's still a tough market out there. Well, no, it isn't. If you got a good project, if they can't raise money, they don't deserve it. And the other thing I think is when you look at fundamentals, For producers, do you have free cash flow? Do you have bottom line net earnings, or is it just a lot of talk? So the people who have gotten, and this is, I think, a very healthy thing for this sector. So a lot of garbage companies aren't going up and embarrassing everybody down the road if they sell off. The people who've been coming in the last year or two are starting to, and again, it's more the sophisticated investors, less so still retail investors. They are more discerning. They're not jumping at anybody that seems to have a good story. They're looking at two things. Number one, if it's a producing company now or is on the cusp of it, what are the economics? It's like show me the money. So that's a big deal. When it comes to exploration stories, what is legitimately an outlier of a story? I mean, there is no shortage of companies out there. I follow some of them and I like some of them. There's no shortage of companies out there that have got an existing 300,000 ounce gold resource that might look halfway decent, and if they do this, and this, they can grow it to 450,000 ounces and maybe have a little starter mine. That doesn't wow anybody all that much. Can you add a zero to it? You have an existing resource that you can turn into 3 million ounces.
Yes, tier one.
Is there a case to be made for that? So you want to look at that as well, because there are a lot of flimsy exploration stories out there that really are going to take years to develop if they can get the money. So those are the few things that I look at.
One said company that checks off the boxes that you just alluded to in terms of the jockey and being able to acquire capital from strategic investors, in particular Eric Sprott in two recent raises in October and December. Let's discuss Apollo Silver. For someone new to the proposition, what intrigues you about Apollo Silver?
Well, I'm going to use pretty much that same list that I just mentioned. Bet on the jockey. You can count on the fingers of one hand. The people, if you go back 4 or 5 years ago, when Andy Bowering, who's the executive chairman of Apollo, when he started that company, basically on his name, he was able to raise during COVID, when no one was able to raise money, or so they said. This guy raised $50 million on his name to start the company. And as you said, more recently, has added more investment money from Eric Sprott, from Jupiter Asset Management and others. The guy is a proven jockey. He's had numerous big winners, companies he's grown from nothing into multi-$100 million or better companies. So that's number one. You can hardly, you can't find very many jockeys that have got that kind of reputation, as does Andy. Secondly, as I said, he's been able to raise money, now during good times, and the projects that he's got. I mean, the company has got one flagship project right now, Calico in California, has, when you add up measured and indicated and inferred, going on, 170 or 80 million ounces of silver in the U.S. Silver is a critical metal. They have resources of zinc and barite, also critical metals. The real blue sky when it comes to a juicy exploration story is a property that they optioned several months ago called Cinco de Mayo in Chihuahua State in Mexico. That's got massive exploration upside. It could be a huge project, and Andy's had huge projects in Mexico. The company had a problem with a prior owner of this ground. They lost their social license, and Andy is trying to get it back on the behalf of Apollo and Apollo shareholders. And last that he and I talked on this not all that long ago, they were making some headway, and I think in the very near term, they're going to have some more head-to-head talks with the locals there, and hopefully a positive decision.
Yeah, the Cinco de Mayo, which you're alluding to right now, is in Mexico. And this was, if you go back 10, 15 years ago, this was the project that everyone liked, the Cinderella, if you will. It was under Mag Silver. And
right.
It is now in their portfolio, meaning their portfolio, Apollo Silver. Now, upcoming catalysts. What are the next 2 or 3 milestones for Apollo Silver that you believe will finally force the market to re-rate the stock?
Well, starting from the last thing we mentioned first, I think that once it's official, and nothing is guaranteed yet, but once it's official, hopefully, that Apollo has been blessed by the locals who have the decision-making power under Mexico's system to grant them this multi-decade license, basically, to go in there and develop this. And Apollo has been very generous in what it's offered the local government and infrastructure and jobs and the whole deal. That, I think, will be an attention getter and bring people in who might be a little bit hesitant right now until it's a done deal that they have the the concession granted on Cinco de Mayo. Back here in the U.S., when it comes to the Calico project in California, there are a couple of development-related steps that the company has to get under its belt to flesh out a little bit more the specific economics and recovery. Also, a biggie is going to be the water, because they're in an area that's not exactly like the lake-filled areas I'm in here in Florida, lakes and rivers and ocean, or where my kids live up in the upper Midwest. There's not a whole lot of water there. There are a couple of options that Apollo has, and what encourages me, Maurice, is that, and I've talked with both Andy about this and his CEO, Ross McElroy, in coming out with their updated resource last year, they showed a substantial barite resource, of which in the U.S. we basically produce none. And for people who don't know what barite is, it's a lubricant. It's used very heavily in the energy industry for drilling mud and things like that. We need that. And it's why it's on the critical minerals list, is because we don't produce it here in the U.S. anymore. Energy companies have to import that from other places. So I think that's going to give them, it has given them some leverage in talks with the federal government over, okay, we can help with the barite and with the zinc, which is also critical, silver, which is also critical. Let's figure out if we can get the water thing solved. And there's incentive by both sides, I think, to do that. Again, not a done deal yet. But when the market sees that, if and when that announcement comes, that's going to bring some people in also.
Well, we're looking forward to these catalysts. And by the way, for anyone interested in Apollo Silver, the ticker symbol is APGO. In closing, what keeps you up at night that we don't know about?
Well, I guess I'm a pretty easygoing guy, Maurice. We've known one another for a long time. We tend to laugh and enjoy our company more than obsess over all that's wrong in the world. But having said that, I go back to the two things I alluded to earlier when we started this discussion. Number one, we are way overdue for a pullback in the markets, likely caused by a 2008 style blow off in the obscene levels of debt the world over. I don't necessarily think it'll be the magnitude of what 2008 was, but it's sure as heck going to give everybody pause and question whether we can just continue to inflate our way to prosperity, or as like some people say, borrow our way to prosperity. So what may happen with the bloated markets, our debt system, and so forth. Don't forget, and I alluded to this a minute ago, Jerome Powell last month, when they came out with this last, for the time being, at least 25 basis point rate cut to the federal funds rate, that was expected. What was unexpected was when Powell basically trotted out a new version of quantitative easing. He said they're going to inject $40 billion a month back into the markets, and they removed completely the cap on the level of the central bank's open market operations. This happened before. This happened in late 2019. And back then, Powell's euphemism was he said he had discovered a plumbing problem in the system that was requiring the Fed to shovel all this money into the overnight markets to keep everybody liquid because everything was getting stressed. I mean, you can only borrow yourself toward prosperity for so long before you at least have to start servicing things, and everything's got to work. So we're really out over our skis with all of this funny money that's been created in the recent past. And so that's problem number one, which exists no matter what else is going on. And what makes things even more interesting, and I use the word interesting, is President Trump. And, love him or hate him, this guy is a bull in the china closet in the world right now. He's a disruptor. He's doing some good things. He's doing some dopey things. And some of those dopey things, including what he's trying to do to the Federal Reserve right now, in my opinion, could really cause markets to rebel. And it's not going to take much because, when everybody is buying, things look great. Few people start to sell, they don't look so great. And so if confidence is broken that we can continue this inflationary, wonderful ride everywhere, stocks go up, real estate goes up, metals go up, everything does, to all of a sudden you got to start covering some of these bets. Then we had a problem. Yes. And he's exacerbating it in some ways. And again, not that we don't need a lot of the stuff that he has talked about, but some of the methodology, and that's a story for another day, leaves a bit to be desired, and it's going to cause a problem.
Last question, sir. What did I forget to ask?
I don't really think anything, Maurice. I think, I think we covered a lot of different stuff, bang, bang, in a short time. So that's good. I think that what needs to come out of all of this eventually is a much more serious discussion of monetary reform itself. When the president came out the other day with his broadsides against the Fed and more name calling and stuff like that, I loved what Justin Amash said, the former congressman who is he believes the MAGA rhetoric, as do some other people, unlike apparently President Trump himself these days. And he said, and I'm kind of paraphrasing, I don't have the quote right in front of me, he said that my problem is the Federal Reserve exists.
Exactly.
Okay, it shouldn't. Donald Trump's problem is that the Federal Reserve doesn't exist solely to serve him. And that's where we're at. And one of the things that must come out of all of this, and I think a lot of troubles to come monetarily, is we're way past time having a national conversation of, okay, this doesn't work. The American people shouldn't be paying $1.25 trillion a year and rising for what should be our own money and our own credit. Let's have a serious talk about how we extricate ourselves from central banking and figure out a better way forward.
And one of the best ways to position yourself again is to own physical precious metals.
Sure.
I implore you to give me a call at 855-505-1900. Sir, for those who want to see how you piece these macro puzzles together, where can they find your work and what can they expect from your latest research?
Well, go first of all to nationalinvestor.com. That's kind of got everything there, all of my recent commentaries. If you want my specific investment recommendations, we're a membership-based organization, so you can figure out how to subscribe there. Also go to yourmoneytoday.org, which is my own podcast. It's going to be a lot more frequent here in 2026. I resurrected it last year. It seems like for a long time I've been on everybody else's podcast but my own. So we're going to do more of that. And again, I look at things, I try and break things down to where it's understandable, common sense, and you can understand the world in which we live, because you can't even understand what the president is doing, what Congress is doing, what their objectives are without understanding first the backdrop against which all of this is going on. And I said before Trump even got inaugurated again, he's stepping into the worst mess of any president probably since Jimmy Carter. Because don't forget, it wasn't Jimmy Carter that caused the inflation and cheap dollar and everything like that of the 70s. Richard Nixon and Arthur Burns, his Fed chairman, started that whole thing with breaking us away from the gold standard and with debauching the currency. Likewise, Donald Trump came back in with this 35 or 6 when he came back in, $1 trillion debt, and with the whole system so stretched that it almost doesn't matter what he does. And so I break all that down, make it understandable, and help you know where to zig and zag and, with your portfolio in light of all those things.
And on that note, Mr. Temple, it's been a pleasure speaking with you. Wishing you the absolute best, sir.
And to you too. I can't wait till our paths cross again. We haven't seen one another in person in a while.
Yes, sir. Looking forward to it.
The information presented on Proven and Probable is provided for educational and informational purposes only, without any express or implied warranty of any kind, including warranties of accuracy, completeness, or fitness for any particular purpose. The information is not intended to be and does not constitute financial, investment, or trading advice, or any other advice. You should not make any financial, investment, or trading decision based on any of the information presented without first undertaking independent due diligence and consultation with a professional broker or competent financial advisor.